Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Schuurman.
Welcome everybody to this week's episode of Sparta Market Outlook. I'm Felipe Elink Schuurman and I'm joined today by our group of experts in oil and freight. So let's start with Jorge. How are you, Jorge?
Hi, Felipe. Very good.
Covering light ends. We also have James today on the middle distillate side. Hi, James. How are you?
Yeah, very well, thanks. How about yourself?
All good. All good. Thank you. Today we're joined as well by Michael, our freight guru. Hi, Michael. How are you?
Good, thank you. Hey, everyone. Happy to join.
Excellent. And of course, last but not least, Neil, the cornerstone of our podcast and research. How are you, Neil?
All good, thanks. Yeah, not been on in a few weeks.
Yes, you were out, feeling better?
All good. Yeah, much recovered.
Okay. So, Lunar New Year, currently this week, I think is the year of the snake. Are you guys snakes as well? You know, you don't know? Maybe something that we need to discover.
I'm from the early 80s. I'm a year of the dog.
The dog, okay.
I don't know.
Yeah, we have to discover it.
I think for my biggest embarrassment, I think I was the rat, but I need to double check it. Yeah, anyway. I don't actually know what all of these things mean. You know, it's something maybe to explore, but it must be fun to see what kind of association we find. Anyway, a lot of things to discuss this week. As usual, we will have the main presence in our podcast of Mr. Trump that is making news and waves every single week. I mean, you might love the guy, you might hate the guy, but at least, there's a lot of entertainment in the commodities market. Well, I don't know if it's entertainment, but a lot of movement, at least, based on what he says, does, thinks, publishes. So we'll obviously have to discuss about that and the fast-moving world of politics. But then, as you know, we'll talk about sanctions, etc. But then obviously we'll move more into the nitty-gritty fundamentals around oil. So let's start with that. Maybe you guys can give an update on OFAC sanctions and, now it's been a month now or maybe 3 weeks. What's been the impact that we've seen so far?
I'm happy to go first, Michael, and then do you want to jump in or maybe just wherever you see fit?
Yeah, sounds good. Go for it.
So I guess it's like mostly related to the crude market in a way, right? So I think what's changed over the last 10 days is that the trading community has realized that the impact of these sanctions is going to be much less severe than maybe the initial panic buying would have suggested, and also just the initial action on flat price. You can see that already in terms of flat price itself. So obviously we're drifting lower. We're lower than I think we were pre-sanctions announcement. Same type of thing with spreads. And one thing on the physical market just to note is that obviously it's Lunar New Year, so we have limited sort of additional price information from the Eastern market this week. But next week, I presume it's going to resume a bit. So there's maybe a couple of things on OFAC sanctions. So there's a thing about timing and insurance. So there's a 2-month grace period. It looks like that will be fully utilized, and that also gives gives the Russian fleet or the dark fleet plenty time basically to rejig itself, so to speak. And then there's sort of a consensus forming that the dark fleet is not actually going to be that stretched. So the biggest impact or the biggest notional impact is going to be on the ESPO trade, which loads out of Cosmino in the Far East. When all of that goes to China, reportedly repositioning here has already begun. So massive freight rates basically in the ESPO trade. So reportedly you could make $7 million doing the 1-week ESPO journey. And there's already basically tankers heading east to take advantage of this. The second thing is there's other relief valves, right? So the thinking is that there'll be more STS activity out of the Baltic to try to basically apply the Urals trade. And then there's also the price cap, which is $60 still at this point in time. And that's the sort of backstop. So if Urals and Espo heads below that, that's when we can start to get the legitimate fleet involved. And that's why there's lots of talk about potentially the Greek-owned Afra market taking advantage of this if and when it happens. It's very difficult to track the Urals price. So obviously we have a price from Argus. There's a bit of a can of worms about what these diffs mean at the moment, but I can just say that they're heading closer to $60, much closer than they were. So it looks like we're heading in that direction for the time being. But generally, the three things to take is that timing wise, it's not as severe. The thinking is that the dark fleet won't be so stretched, and whatever impact there is on Russian volumes is going to be short term. Is that fair, Michael?
Yeah, so I totally agree that I'm somewhat skeptical of the high long-term impact. And what that stems from is just in the last week or so, got the report that the Shandong port in China was rolling back their ban on US sanctioned vessels. And my gut feel is that by March 12th, which is the end of the grace period, the Indian ports likely do the same. And if the ports are not sanctioning, well, embracing these sanctions across China and India, then I don't think there's going to be any real impact for the typical fleet trade flows. So what really would need to happen to have these sanctions have a material impact would be basically all Chinese ports and all Indian ports say that blanket ban, they're not going to accept any sanctioned vessels. And the sanctions on paper look like they have a really big impact because those sanctioned vessels carried over 1.5 MBD of Russian oil in 2024, which amounts to over a third of exports. And if ports stopped accepting this, then Russia would really need to move their oil prices below the price cap of $60, and then that would benefit DPP rates overall. But the way that China and India have acted over the last few years, I'm just not convinced that they're going to do this. So that's my 2 cents looking out over the next 6 to 8 weeks.
Yeah. And of course, we talked about Trump and all of the tariff threats that he's put on to pretty much, anyone under the sun, but most recently Canada, Mexico, Colombia. Is there a chance, or what do you guys think? And again, this anyone's guess, but what do you guys think that will he be threatening to put in some tariffs to India? China is a different story, but India particularly.
Well, sorry, Michael, on you go.
I was going to say, Neil, with Trump, he really runs his presidency off of Twitter or X, and he'll wake up one morning and someone from another country will have taken a swipe at him, and it could be India about something immigration related, and then he tries to retaliate with something oil related as they try and grow their economy. It's so hard to predict.
Yeah.
It's definitely possible.
But let's just say specifically for the oil market, if Trump comes out and says, okay, I'm going to put another 200 vessels on the list, do we think we get the same pattern again? So you get this panic buying and you get flat price, let's say $5-10 or something. But then the reality will be after a couple of weeks, the market will again realize, okay, we can deal with this. Is that fair to say? Or will the dark fleet get ever more stretched somehow?
I think we have a rinse and repeat. I think we have kind of what we saw on DPP rates 3 weeks ago, where TD3 jumped 50% higher, but then came off and basically lost all of that. And just in the last week or so has found kind of a new equilibrium. We likely see the same thing happen again if Trump were to do that. And just to reiterate, I really think the individual ports across India would have to buy into these sanctions and say, okay, we truly are not accepting the dark fleet. But again, I'm not yet convinced that we'll see that happen.
Yeah, no, that's a very good question, Neil, that you asked. Ultimately, I think that the relationships of the BRICS that obviously involve Russia, India, and China is not an ideological kind of relationship. It's much more, we currently have aligned interests, but we will no longer, if we don't have those aligned interests, then BRICS is, is not built on solid foundations that are ideological or anything like that, like the Western alliances, NATO, or things like that. So, and again, those are shaky right now as well. But what I'm trying to say here is that I agree with you, Michael. It's a rinse and repeat situation for the time being. But if India then starts seeing that there has more interest to be aligned with the US rather than being sort of neutral as they are right now, things might change because, again, there's no ideological alliance here.
For sure. Totally agree.
And that's something we said a few weeks back, right? So if we're talking about wider geopolitical and wider macroeconomic incentives, if China is faced, or let's say India, if India is faced with either you start buying Russian or I put 15% tariffs on you, what are they going to choose? Like which one's more damaging? And the same can be applied to sort of Iran going to China and all this kind of stuff. So it's not a done deal that, he can't do anything about Indian and Chinese buying. It's just, how far he wants to go basically to make that happen.
True. So anyway, interesting. So again, just to summarize, for the time being, until we have more evidence of Trump, threatening India, the key player here, I think it's India. As long as India says, you know what, we will continue buying Russian crude, this situation will be a rinse and repeat, as you said, Michael. Moving on to crude. What can you tell us about crude right now, Neil? What's your opinion?
Yeah, I've only got one, let's say, concrete trade idea, I suppose, at the moment. So that's just looking at the EFS. So we're talking about Brent versus Dubai, essentially. And my thinking is that we need a bit of a shakeout in this key spread. So it basically goes like this. We know that the Middle Eastern spot premia are extremely high, but we've just been talking about the fact that we think this is much ado about nothing, so to speak, in terms of the sanctions.
By the rumors,
so what
that kind of situation.
Yeah. So once sort of trading resumes in the East next week, because now we're in the Lunar New Year, trading's very slow. I think we start to see the Dubai market cool down substantially, and that involves also the physical premium out of the Middle East. And then, if we move back to our tool, what do we see the last week? As we said last week with Phil, there's lots of crude open or near open to the east from the west. That's true of light crude, it's true of WTI, it's true of CPC, 40s. Sverdrup has been moving east as well on VLCCs. So I think you get like an equilibrium forming here where you're bidding up the Western market essentially and you're cooling the Dubai market. I think that's a fairly high conviction kind of trade idea just now. So, and flat price goes into this as well. So you've seen that flat price is now below pre-sanctions level. That's like the geopolitical premium coming out as well. I mean, we can talk about all the other stuff that's been happening in the market with tech stocks and stuff, which I'm sure has had some impact the last few days. But I think you get the sanctions risk is super high still. And I think you tend to see, I think flat price is a bit of a buy, and that also heads into the same direction in terms of the EFS, because you tend to bid up the Brent market then. So that's really it. There's a few other question marks. The one is the Suez versus Cape route. So if you get lower freight costs to move crude west to east, that goes in the same direction, right? Because it allows Brent to be bid up more against Dubai if freight costs are lower. Michael, what do you think about that in terms of how close are we to opening up Suez again?
Yeah, so a couple things on that. I think we're closer than people think to seeing a lot more Suez routings. And this is because your classic ship owners, if one of them takes the risk and makes the journey, basically you'll then start to see everybody else do it. As soon as one respected ship owner takes the risk and gets their vessel insured, everybody else will be pressuring their insurance agencies to do the same. And then we get a lot fewer Cape routings. And also I've been hearing of Suez Canal rebates, and the Suez Canal really, really wants business. There's been a lot of talk of rebates to entice ships to go through. So with lower Suez Canal rates, war risk premium coming off, I don't think it'll be months before we see a material uptick in Red Sea and Suez readings. I think it'll be weeks. And this...
Very interesting. Yeah.
This doesn't help freight rates, but it'll be nice to see ships going through the Red Sea and the Suez Canal again.
And we had a piece of news the other day that some vessels were now returning, let's say. Wasn't quite clear if that was an oil tanker or not, but
So I had a
There's
look.
rumblings about it.
Yeah, I had a look with the AIS data, and I saw a naphtha cargo that had just traversed south through the canal. This was a couple of days ago. And I also saw an uptick of basically from almost no cargoes in the north of the Red Sea to seeing four. And I was just looking at tankers. So we are starting to see more, but none of the ship owners were what I would call name brand. So once we see that one bigger name brand ship owner start to make a move, that's when I think all the pieces fall in line.
Okay, so we're almost there, and that's
Yeah,
relevant for obviously all the things we'll talk about later in the pod as well.
Yeah, indeed.
exactly.
Okay.
Excellent. Thank you for that. On OSP, anything else to add, Neil, or?
Yeah, it's maybe one caveat just because that's what the market's turning its thinking to now, and relevant to this as well is that there's an OPEC meeting on the 3rd of February. So presumably after that we'll get the OSPs. And it's also a question around the Asian margins. So in theory, there's loads of room to raise OSPs, right? So it looks like there's maybe $2 or $3 per barrel looking at A, the margin, B, the Dubai structure, because that's one of the main ingredients into the OSP recipe, so to speak, is the change in Dubai structure each month. And it looks like you could get as much as, let's say, $3 per barrel raise in OSPs. The only problem is Asian margins are under a lot of pressure already, partly because of the spot diffs out of the Middle East. So if they raise OSPs $3 per barrel, you're killing Asian baseload margins. And the question is, what happens after that? Do they turn to the spot market a bit more? Do they turn to the West of Suez market? Or do they just reduce runs? So that's another option. I think either way, you can't see very high incentives to pick up spot crude out in the Middle East just now anyway. So you've got those two options of running lower or turning to West of Suez crude. The margins on Oman right now, cracking margins, are barely workable. There's a few sort of West of Suez crudes that are workable into the Far East. There's still a bit of room, but I think that's the key question. I suspect maybe the Saudis are a bit more sensitive to the margin picture just now, and they maybe don't raise OSPs as much as they, in theory, could. I might be very wrong in this. We'll find out in 1 or 2 weeks, but I think there's a notion that
Yeah, but let's
they
check
won't
it out.
fully utilize the OSP.
But that's interesting because speaking to you earlier, I thought it was your view that we really won't see run cuts in Asia.
I think as things stand, I think as things stand, if they're not too aggressive on OSPs and you see a cooling in the spot diffs out of the Middle East, which I think will happen almost either way, then it's a very short-term signal for Asian refiners to cut. And refiners always complain about the margin, right? And there's grumblings about the margin for weeks and weeks, and then maybe a month or two later you start to see something in utilization if the margins remain very low. But I think this is a short-term dip in the margin. Most of it's coming from the spot diffs just now. And then we can talk about, Asian gasoline. We talked about that last week being, let's say, unexplainably weak, and things have changed, so as we'll find out later. So that from the product side, there's maybe a bit more hope as well.
And besides, you were saying you're saying that WTI is actually cheap into Asia, which in a way sort of makes sense if Asian premiums go up, but not into Europe, this is quite unusual, no? So there's an alternative there for margins to improve through West of Suez barrels, etc. So that theory makes sense to me. Yeah.
Yeah, and that's for just the last note. It's quite unusual, I think. Yeah, as you said, TI is not very cheap in Europe, and I think that goes in the same direction as the EFS trade, in the sense that I think there were high arrivals of TI in January. It looks much less in February into Europe, and that when you get that tends to also be bullish for the North Sea market, right? Because that's a huge baseload type of crude is TI in Europe these days. So I think it all goes in the same direction. I'm fairly convinced that most of these moving parts all go in the same direction at the moment.
Well, you could argue as well that if it's not open, it's because maybe Europe. Well, yeah, no, exactly. Europe is too cheap. Yeah, that's. I need another coffee. Yeah, makes sense. Yeah. Okay. Anything else to add on crude?
That's it. I'll let the others talk.
So James, moving to you on middle distillates. It feels
Yes.
marginally, we're seeing a bit more pressure in Europe at the moment, following a very strong bullish start of the year. What can you tell us about it? What has happened? What's changed?
Yeah, so I think actually probably today we're going to need to talk about the kind of global Middle East picture in quite a separate regional way because it's been a little bit divergent actually. But to be fair, I guess last week I was calling for quite a bullish move on ice gas oil spreads and cracks.
Mhm.
And though we saw some of that towards the end of last week, actually overall it's kind of just been very flat ice gas oil cracks and spreads over
Okay.
the last week or so. Whereas in the US, we've kind of seen heating oil cracks and spreads continue to move up in general over the last week. And Singapore is quite divergent between diesel and jet. So we've seen Singapore diesel cracks and spreads more in the crack, it should be said, come off. Whereas actually jet spreads have actually moved up quite a fair bit. But I guess one uniform characteristic across all of them is that all of them remain in backwardation all the way down the curve, essentially. But I guess if I'm being honest, I've kind of moderated my view to more of a bearish view, particularly on ice gas oil, to be very precise, into the kind of short term, as it were. We could talk more about the medium term later, perhaps. And yeah, some of the reasons for that. Yeah, so we've seen ARBs into Northwest Europe move towards being more workable, particularly from the US. So the US Gulf ARB to Europe has been, especially to Northwest Europe, has been open for much of the past week. There's a few reasons for this. Brazilian diesel premia have come off to their lowest levels in like over a year. I want to be very precise here. We've seen a slight coming off or narrowing of the HOGO over the last week or so. Some kind of moderating effect of like weather getting slightly warmer there. And also, I think probably perhaps most importantly, we've seen like colonial line 2 space move to the negative values over much of the last week. So that's a sign that probably the colonial arb into New York is closed. Therefore, more molecules are freed up to possibly move into Europe. And that kind of also might explain some of the positive moves we've seen in heating oil cracks and spreads as well. We've seen like swing barrels from the Middle East, although for diesel, they still really point east. For two factors, we've seen like a slight widening of the east-west on gas oil. Therefore, the margin to move east versus west has narrowed to something like about $50 per barrel. Actually, we spoke about jet earlier before. Actually, the difference between east and west for jet is more dramatic. So we're still seeing more jet molecules from the Middle East moving east, or should do. And that's actually been reflected also in the Singapore regrade, narrowing quite dramatically over the last week.
Sorry to interrupt. All of these are talking on east-west perspective. Is this via Cape or is this via Suez? It's, I guess, via Cape, right?
Yeah. When I'm looking at this, and that's why I was very interested in what Michael was saying. When I'm looking at this now, I'm still comparing Cape routing to Europe
Correct,
or to America actually versus east to Singapore.
Yeah, I know. So that's why I'm bringing it up now. So any idea of what that would mean if we started looking at Suez freight rates in terms of the ARBs from the Middle East into the US, into Europe?
Yeah, so if you were to look at those calculations, which you can do in our platform, then even the difference between east and west on diesel and jet is even more narrow.
Yeah.
I guess I want to add one caveat there because those calculations don't show things like additional war risk premia and stuff like that, additional insurance premia to move via the Suez. But yes, it is a more narrow picture if you consider that. And actually, something quite interesting I've been thinking about there as well is that this move back to flowing via the Suez probably is a more dramatic move, more important for jet than diesel actually in a way, because it tends to be that all jet tends to flow from east to west. Almost 100% of it comes through the Suez to Europe in general. Whereas like at least Europe can pull from both, for diesel wise, can pull both from the US and Asia. So that's something to consider. Now, another factor why I've kind of moved like moderately bearish is, and I think something that people haven't really spoken about a lot, is the approaching or the increasing runs in West Africa, probably moving close to like 500 KBD. It's what we're talking about, Port Harcourt, Dangote. And we've started to see some of that weakness manifesting kind of 0.1 diffs in Northwest Europe and in the Med as well.
So those are the lowest since 2018, by the way, which is a fairly, I have to check that, but when I looked a couple of days ago, it's the lowest 0.1 diff.
Yeah, I think you're right on
For
that. I think that
8 years.
sounds about right. For a long time, at least, anyway. And kind of moving to the US, so at least from the US Gulf side, probably, and that's kind of, so I want to be very clear here, kind of like a moderately bearish view, Europe, diesel, probably more bullish, European jet actually. On the east, probably a bearish view on diesel, a bullish view on jet. And moving to the US, I'm kind of bullish overall, I would say. And I think that's probably because from the US Gulf, I still have like a bullish view. We've seen like US runs already reduced over the last period of time. We saw a little bit actually of demand destruction from the recent storms they've had in the US as well, I think on diesel side. And that should probably come back now as well. And I think probably, I don't know if Michael wanted to talk a little bit about TC14 freight rates there as well.
Yeah, James. So the Atlantic Basin diesel flows in regards to the MR market have made January quite interesting. So back in the first week of the new year, we saw reversed diesel flows basically to normal.
Yes.
We saw diesel cargo inquiry and jet from Northwest Europe into the US East Coast. And from what I saw in the platform, those arb margins got as close to zero as something like 1.75 CPG. And normally when I look at them, they're -8 to -12 CPG. And what I was seeing in the market was a lot more MR inquiry to charterers to carry diesel heading west to the US. And this really helped TC2 rally at the time. And then what we saw was, although a lot of vessels went on subs, several of them failed, mainly because diesel traders couldn't make that cargo work in the end. Maybe their econs were just on the edge of workable, but then the arb didn't move where they needed it to, or for whatever reason. But the issue in the freight market is when the market sees a rapid fire of failed fixtures, even if it's only 3, 4, 5 of them, it destroys sentiment very quickly. And that's what we started to see about 2 weeks ago when TC2 started to come off. So we did see some of these diesel cargoes move, but not all of them. And at the same time, when I was looking at the diesel arb margins coming out of Houston heading into Northwest Europe at this time, they were shut by something like $20, $25 a ton, which makes sense just given the flows. But it was a really interesting January of where the demand for diesel cargoes was. And it seems to have flipped back a little bit more to the norm. Like I know you were just talking about the US Gulf Coast. I'm seeing those margins to carry diesel into ARA at something like -5, -6, but that's a $15 improvement over 7 to 10 days ago. So that's been interesting. But the US Gulf Coast, from a freight standpoint, has been quite boring, really, over the last 2 weeks. A lot of the arb margins out of the region have been shut. Tonnage is in line with the trailing average, really, of call it roughly 15, 16 vessels. The only thing that's been helping this market repeat last done freight rates is that there haven't been a lot of ballasters. That could change just because of a flip in some weather patterns. East Coast Mexico weather had been delaying a lot of vessels ballasting back to the US, but that has cleared. But now there's a lot of fog in the Houston and Corpus Christi ship channels, and that is delaying some vessels to load. So there's basically this congestion that's now forming over, say, the next 7 to 10 days in the US Gulf Coast. And unless our margins start to improve and uptick demand out of the region, I just don't see any reason for TC14 rates to move much higher in the next 7 to 14 days.
Okay, interesting. Yeah, and
it's been an interesting month.
Yeah, thanks very much. Yeah, it's really interesting that you mentioned the increasing margins to move diesel from the US Gulf into Europe, because in summary, really, that's kind of the main thing that's making me have a moderately bearish view in the short term on ice gas oil spreads and cracks.
Yeah, makes sense.
So yeah, kind of altogether in summary, I guess I think Asian diesel is looking weaker. I'm bearish over the next period of time. Jet bullish. So yeah, there's an argument to move bearish ice gas oil spreads and cracks, MOPS diesel spreads and cracks as well. And I guess the kind of turning points that I'm looking that would change that view. So we've got US Gulf turnarounds starting imminently. which is going to add to that bullish picture in the US that we spoke about before,
Hmm.
and maybe then flow into a kind of more bullish view on ice gas oil cracks and spreads in the medium term, not in the very. We've got North European turnaround starting as well, I think towards the end of February, although those are rumored to be, and from our analysis we've seen, are going to be lighter than normal this year. And we've kind of got continuing a Middle Eastern turnarounds going on now, with them set to increase a little bit as we move towards the end of February. For example, Reliance Jamnagar is going to go to like 60% run rates, I believe, by the end of February. And something why I was really interested in what Neil was saying is also, are we going to see these continuing reducing refinery margins in Asia lead to run cuts? So that'd be something important to monitor as well.
Okay.
That's how I feel.
No, thank you. Thank you for that. Very clear. Moving on to light ends, Jorge, we spoke last week about this surprising fall in spreads, cracks, west, etc. on the gasoline side. Maybe I thought, we didn't think about it last week, but since we were talking about the Lunar New Year, maybe it was just people getting out of their positions before going on holiday, and that was it. I mean, it's
Yeah.
not the first time that this happens. Michael, you've been talking about the Thanksgiving, freight market on the other way
Yeah.
around. People fixing vessels before Thanksgiving. Maybe here it's just people getting out of positions. I don't know, but what have we seen this week, and what do you think is going to happen, Jorge?
Yeah, we have a lot of things this week. There is a lot of divergence between the main trading hubs, but let's start with Singapore because we talked about it last week. As you say, we saw a big drop on East West in the previous week. We have seen a correction or a reversal during this week. We were talking about that. We didn't see a lot of fundamentals pointing on that direction, and the market has recovered. And we see East West at the same level for February and March that we were seeing it 2 weeks ago. So from that point, our view keep being constructive for this West. I think that looking at the pure fundamentals, the refinery margins in Asia are very low, like Neil has said, and gasoline can be one of the source of them to increase. Then we have southern refineries shutting down recently. We have seen a lot of news about this after the new tax system in China. And yeah, East West remains in historical lows, despite the increase that we have seen during the last week, 10 days. We are seeing it in historical lows. So there is more room to go higher. Yeah, and the stocks are low. We have seen the data from Singapore. They are in 7 weeks low. So that is supportive as well. And the last point I will show in that direction is the ARBs. We are seeing the ARBs working from Singapore into Pakistan, Australia, Indonesia, even Jammu. And one thing that we talked, I don't remember it last week or the previous one, it's an LR1 from Singapore is competitive into Nigeria, not for February deliveries, but for March deliveries. So it's still cheaper than an MR from ARA or Houston.
Is it still the case? Is it still the case that
Yeah,
Singapore LR1 lands cheaper than an MR?
Yeah.
Okay.
In this
Interesting.
case, for March deliveries, the last time we talked about it, we were seeing February deliveries. Right now, for March deliveries, it's still cheap, and I think more than $10 per metric ton. Comparing LR
LR1
against
to MR,
MR,
which
yeah.
it's
So,
not a one-to-one comparison, but
Yeah.
it's and if you compare LR1 to LR1, what would be the spread?
it will be cheaper from ARA, yeah.
By how much, more or less?
Maybe something close to $6 per metric ton, maybe a little bit more.
Yeah. And I'm jumping the gun here, but we talked about this before. You were saying as well that Gulf Coast is also the cheapest source of supply on an MR basis into WAF?
Yeah, exactly. And that's for February. That's
for February.
Yeah,
Okay.
that's for February. Yeah, Singapore is right now the cheapest one with a difference of $5 per metric ton. Yeah, I was going to talk about it in the ARA piece,
No. So
but
sorry.
it's something like very, very interesting.
It's something, let's pick that up.
Yeah.
Let's finish with Singapore, and there's also obviously a freight section on Singapore, but WAF, Singapore, Gulf Coast, all pointing into WAF. It's a rare phenomenon. So
Yeah,
let's
exactly.
discuss about that later.
Yeah.
On freight, what do you see, Michael, the impact based on what Jorge was saying, what do you think it's the impact on freight?
Yeah, so a couple of weeks ago, it was clear that Singapore was pricing into the West Coast Americas on gasoline better than, say, the US Gulf Coast, which isn't all that common, and it's at least, say, 2 CPG in the money. And we started to see more gasoline fixtures coming out of Singapore, and then a move higher on TC7 off the back of this. But a few days ago, that then shut again. And now we keep flirting with the US Gulf Coast versus Singapore being, landing cheapest into the West Coast now. And TC7 has started to flatline. Although tonnage supply in the region is manageable, I think there's been some forward fixing in the lead up to Lunar New Year, just because, like Thanksgiving and like Christmas, nobody wants to have to be dealing with fixing a vessel over the holidays. So it'll be interesting to see what happens next week. Will there be a glut of vessels and some of the ARBs not open at the same time? It's hard to tell if they've fixed all the vessels they need to in the lead up, or if they're gonna rush to fix, say, next Monday.
Thanks for that. Jorge, so in a nutshell, what's your summary of the Asian gasoline market?
Yeah, I think there is potential to keep climbing on the east-west. From a statistical point of view, we are in historical lows, and we have some fundamentals pointing on that direction. Lower stocks, refinery shutting down in China. We have a very weak refinery margins. And the ARBs are looking good out of Singapore. And as Michael said, to Mexico is very tight between US Gulf Coast and Singapore, and we have seen a lot of opportunities out of Singapore.
Yeah, and again, it's important to notice that in our tool we obviously monitor the ARB from Singapore into, let's say, the west coast of the U.S., Chile, Ecuador, etc. But most traders actually export directly from China, from Korea, and that's something that obviously it's difficult for us to monitor. But if it is open from Singapore, it is definitely open from China, Korea directly, since you can avoid the double freight and things like that. So it's something just to keep in mind, that if you see fixtures from Singapore, then you can imagine many more from the north, from China and Korea, Japan, etc. Moving on to EBOB. So again, we've seen these threats coming from the east into the main WAF market. Now we're talking about Gulf Coast, but surprisingly, the market actually has rallied. So what's the story there?
Yeah, EBOB has been very strong. I think we can look at it in two ways. First, the time spreads. We have seen a very big rally during the last week, 10 days. And then we have a very strong components. I think the components is more like a long-term story. They have been increasing steady since the last month and a half. But the time spread...
Any particular component, the high octanes, right?
Yeah. Heavy, aromatic, lower BP, so they're more suitable for summer. Yeah. Mm-hmm. And on the time spreads, we have seen a very big jump, especially for February, March, which is going to start to be the prompt tomorrow. But we have seen a very big spike there during the last days. And the ARBs are not looking very good out of ARA. As we say, they are not the cheapest source into West Africa, neither for February deliveries, nor for March. So the only markets that right now in our tool look a clear destination for ARA are Ecuador and Colombia. So not even Brazil in Latin America. So the arbitrage outlook doesn't look very promising from ARA. Then why is this rally behind it? I think that even that we are seeing a weaker expectation of West Africa demand, because Dangote is ramping up their production and is going to impact the gasoline market a lot. We have seen a piece of news during this week that the RFCC from Dangote is right now closed. So I think we have seen a short-term spike in the ARA market because it's expected to be more demand from West Africa in the short term. But at the same time, we're seeing ARA losing West African market, at least comparing the delivery prices from different regions. So my view on that, another point, on the physical side, the premium for the 10 ppm didn't move a lot. So that reflects the trade to West Africa from ARA. So I don't see many reasons in this spike, and I think that we will see lower levels in the EBOB market if these situations in the arbitrage remains, and if Dangote's RFCC is back soon.
Yeah, but it's interesting because the Dangote story is obviously meaningful, but at the same time we were seeing that the imports into Nigeria hit a 8-year low. at only
Yeah.
100,000 barrels a day.
Yeah.
So again, even if it, okay, maybe that's historical data. This picks up now with Dangote, maybe, okay, possibly. But again, you then see that the cheapest source of supply is obviously for the prompt is Gulf Coast, and for March it's Singapore. So again, it's putting a cap to the story. Now,
Yeah. So,
if I understand correctly, the story around the increase in spreads is mostly around people buying high octane components, reformat, alkylate, etc., for a contango play and to keep them until April, May, etc. No, and therefore, as a consequence, all of the blend values then become too expensive, and hence the price of blending EBOB goes up, etc. And that's maybe the reason. But can we still store? The question, therefore, is if this is driven by the high octane market, can we still buy high octane right now, store it until April economically? That is something that we need to monitor and see, because that's going to be the limit. At the moment that reformat becomes too expensive, then that's it. The game is over, and the market then should come off based on all of the other elements that we mentioned before.
yeah, I think on Nigeria we have two different stories. The long term is obviously berries, and then we have this short-term spike since early this week, but I don't think it's going to last. Yeah, another fundamental is the the escalation of the components, and yeah, I mean, maybe not say that it's unprofitable now, but it's much less profitable. We were seeing a contango of -7. Right now, contango is -3, and the components are very strong compared to their seasonal levels. The reformate, the light reformate right now is on a premium of $70 per metric ton. So I think it's fair to say that it has gone too high, and that right now it's more likely a correction in the EBOB market.
Understood.
So just to interrupt, how do we tell then? So how is the first sign that the reformate market starts to come off, and then that's the first signpost that the storage play is not working out anymore? Is that a fair statement? Because I'm sort of learning about this as well, just for non-gasoline traders out there. Is that the first signpost?
Again, I will check with Miles, but he's the expert here. But historically, I think that if you could store reformat, you could buy reformat now in January, February, and roll it until April at, let's say, April EBOB plus anywhere between $30 and $40 a ton. That was a buy. Okay, it depends on gas naphtha, where gas naphtha is, etc. But it's one of those things where you're buying an optionality. It's a limited risk at plus 30, and you're storing components that you will be consuming, that will have high demand, and probably you can make maybe $10, $15, $20, $40 a ton margin on those. So the first thing I would look at is the economics. Can you still buy in January and roll it into April at April plus 30, let's say, or 40? If the answer is no, then you'll start losing some appetite, and then theoretically, reformat prices should come down. And it's interesting because, I was talking to one gasoline trader last week, and he was surprised to see that the naphtha arbs were open into New York, whereas the gasoline was completely closed into New York, which is indicating that, in a way, it's indicating that your reformat prices or high octanes are too expensive in Europe. You'd rather buy them in the US and then just ship the naphtha from Europe to the US and blend over there. Again, it's one of those two things that you need to monitor. It obviously impacts the naphtha market and its final destination. Is it ARA or is it New York directly?
Yeah, especially the heavy naphthas into New York, which is more linked to gasoline. Yeah.
Yeah. So does it answer your question, Neil, or?
I think so, yeah. I just need to, it's good. We might as well turn into a sort of gasoline school for the non-gasoline guys each week. Now, I had one more question for you. So, Dangote, I think it's the same as, I just want to highlight this point in the distillate segment as well. I think it's a super important factor that goes under the radar. If WAF runs are really 500,000 barrels a day, they were zero this time last year. And that's a huge, huge difference in the market when you're talking about things like East-West, for example, in the distillate market. That goes a bit under the radar. And the same, I had a question for gasoline, which is, we talk about the ARBs into WAF, but I know there's a short-term RFCC issue, but if WAF is basically not going to be a short market, should we not be discounting very much what this particular ARB signal? in the future, unless Dangote breaks down, of course, and then it becomes much more relevant again.
Well,
Yeah, I think.
no, go ahead. Yeah.
Yeah, I think we definitely have to discount it on the EVOP market, and it's something that we have been talking for more than 1 year now. So it looks like we have been always thinking that it was behind the corner, but it never happened. We never saw like that big drop in the ARA market linked to a decrease in West Africa. But I'm sure it's something that with the latest data and the latest articles that have been published, we are going to see that. That's why my view right now is that not just looking at West African ARPA is the main one to look at, that the EVOP market is, well, points to a correction in the short term.
Yeah, to answer your question, I mean, it's complicated. We've discussed this many times with Michael, for example, around what's going to happen in terms of trade flows, because the Dangote has a very different quality, produces a very different quality to what the country actually needs. So you might find yourself in a situation where they export and they still need to import. Again, it's very political. Dangote wants to be the one supplying the local market. You also have the FX, who holds that Naira dollar exchange rate risk. So there's many elements there that we don't really know what's going to end up happening. So yeah, go ahead.
Well, one just to rebut that is that the headline was imports into WAF or Nigeria are at basically not an all-time low, but an 8-year low.
Yeah.
So just 100 kpd. I don't know what the long-term average is. 400 kpd, something like that.
Yeah.
So does that answer one of the elements? Okay.
Yeah.
They might be producing something slightly different, but the flows are going down a lot.
No. That's, I mean, but there's an ongoing battle. Let's put it that way. There's an ongoing battle going on, and maybe this is just the first chapter, and then we see another chapter.
Yeah.
So for the time being, yes, the evidence shows that you're right. This ARB becomes less relevant going forward, but it's not finished yet. I'm just giving you the nuances of what might.
Yeah.
But on a pure molecule perspective, because if you're importing from ARA and then shipping from WAF to, let's say, Borco or things like that, okay, it doesn't matter in terms of the full molecules. The Europe will be losing shorts globally. If it's not WAF, it's Borco, it's something. So that is the sort of bearish picture into Europe. That's definitely the case.
One last thing regarding this. I'm looking at the EVOP time spread seasonal chart last 10 years for February, March. And before the last spike of these 10 days, we were close to historical lows. So the market was pricing a weak export option. Then we have seen this big correction, and now the market is not even in the average, but is closer to the average. But we come from a bottom that is close to historical lows. So the market was indeed pricing this weakness in the demand from West Africa. But right now, I think that after physical components, blending components are too strong, and the RFCC leak in West Africa, we have seen this spike. But I think looking at the fundamentals, there is not more reason to come back to the previous levels closer to the historical lows.
But again,
it's interesting as well on Dangote, right? Because it's even though it's kind of closed a short in a way, or it's closing a short, it's actually made it more volatile, right? And I guess I think as a trader, that's quite a big opportunity to volatility is better than maybe a massive short. It's something you can trade around.
Well,
that's something I thought about anyway.
What you want is to have the massive short and then to trade around that with volatility. It's like you get the short into West Africa and then you get the optionality of where you're going to supply it from. So depending on East-West, EA, etc. No, losing a short is obviously, as a trader, it's not what you want. But having said that, the volatility is obviously, the trend is your friend. You want a certain volatility within the trend rather than a volatility without any kind of logic, or control. Look, it's for me, why is this important? WAF is because it's in the same way that it's an indicator. It's an indicator that of an imbalance. Okay, now you don't even actually have any kind of physical ARB going from east, from Singapore to WAF or from Gulf Coast to WAF. It's just telling you that on a relative perspective, Gulf Coast is perhaps too cheap, or that ARA is too expensive, or that Singapore is too cheap. That's just the message, if you want, is that it's a signal. Now, it doesn't give you the full depth of that signal. It doesn't tell you can buy at the East-West at a certain level and sell it at this level, because you don't know what is the depth of the volume attached to it. And that's hopefully things that we may be able to do, Neil, in some time in the future. It's one of those things that we would love to do, but it's already a signal that, hey, there's an imbalance. And ultimately, as a trader, that's what you're looking for, is what is the imbalance, And right now, what we're seeing as imbalances is that perhaps Gulf Coast is too cheap, and it's dominating all of the Atlantic basin, including WAF, which is rare, and that Singapore as well is too cheap, and you could actually bring an LR1 into WAF. Ultimately, maybe you will not be able to do anything like that, but on an East-West perspective, it is indicating that the East-West is too cheap. On a spread perspective, it's maybe not indicating anything at all, because you will not be able to send anything to WAF, perhaps, because there's no demand. But on an East-West, it's definitely telling story. Does that make sense?
Yeah.
Very good.
Yeah.
Phew. I mean, I haven't done it in many years.
Still got it.
Well, let's see. Let's talk about it in a week. Anyway, guys, this has been fascinating. Thank you so much for everyone's time. Looking forward to next week's call.
Thank you too.
Actually, next week, Michael, we have a special episode, right?
We do. So we're going to be speaking with a friend, Mads Frink from CM Navigator Maritime. They focus on dry bulk. So we're going to be merging the worlds of wet freight and dry freight and talk about some of the similarities and differences between both, and then some longer term forecasts for both as well next week.
Awesome.
Very
So
cool.
just to clarify, this is an additional episode that we will be recording on Monday. Is that correct?
On Monday.
Yeah, so we're actually enjoying doing these podcasts, I think, and we've got a lot of very positive comments, feedback from the industry.
Cool.
So the idea is that, we want to start inviting guests to our podcast, so maintain this format that we currently have with us, between us at Sparta, but then from time to time invite some guest speakers. So if anyone listening actually wants to participate and would like to share his thoughts about the market, or whether it's gasoline, diesel, crude, fuel oil, because we just launched fuel oil, but also freight, don't hesitate to give us a call or send us a tin or whatever you want. Pigeon, fax, contact us and we'll get you on the pod. Anyway, thank you so much, guys, and I'll speak to you next week.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.